Welcome back. Well, we're going to take a slightly different approach. In our economic weather report, we're going to use historical data, quite a bit of data actually, over 20 years or so, to forecast future trends in the markets. So we take a look at the following histogram bars. The blue ones are month over month, the orange are year over year, and it shows us the different indices such as the S&P 500, which has been up 8.1% on a month over month basis, 13.1% compared to this time last year. The VIX, the volatility index, also known as the fear index, is down 35% on a month over month and year over year basis. Crude oil down 8.6% month over month, flat yearly. The federal funds rate, now this is just the change in interest rates. Obviously, over the past month, they haven't changed. Over the past year, they're up 37.5%. And the 10-1 Treasury spread, which is the difference between the 10-year bond and the 1-year Treasury bond, the difference on a monthly basis, that yield has increased by 48%. On a year over year, minus 20%. So we're going to see how the change in these different indices affects and maybe can forecast stock market trends. So let's take a look at the month over month percentage changes. Again, the S&P 500 has been up 8.1%. The VIX, the volatility index, which usually or always goes opposite to the stock market, has been down 34.5% over the past calendar month. So we see here with the VIX down 34.5%, that places us roughly around here. Now, the blue histogram bars at the bottom, that shows us the 30-day forward performance based on historical data. How can we expect the S&P 500 to perform over the next 30 days? The red histogram bar shows 60 days and the white 90 days. So based on historical performance, this is what the data suggests, how the S&P 500 may perform over the next 30, 60, 90 days. Well, we can see very clearly that when the VIX is up 120, 130, up to 200% on the month over month basis, this is when we can expect the superior returns from the stock market. Because essentially, when the VIX goes up, it means the stock market has already gone down a lot. And then therefore, looking forward, we may expect the market to, the stock market to rebound. And that's why these results are so good. But keep in mind, these results only start to really look good when the VIX is above 120% over the past month, which means if the VIX is, let's say, 15, it has to jump to 18. I'm sorry, not 18, but let's say 30. It has to basically double. It has to go up at least 100%. That obviously doesn't take place every day, most likely only during market crashes, but that's what the data does suggest. We do see minor stock market rallies when the VIX is up 30 or 40% on a monthly basis. However, when we see the VIX is up between 50 to 100%, it generally means that the market has gone down, the VIX has gone up moderately, which means the market has gone down moderately, which means we may expect the stock market to continue lower. Where are we now? The VIX is down about 34% in the past 30 days. So you would expect very minor, about 1% returns on the S&P 500 over the 30, 60, 90-day periods. We then take a look at crude oil, which is down 8.6% over the past month. Well, same chart applies. Blue histogram bar shows 30, then the red 60, and the white 90-day forward performance on the S&P 500. Well, given that crude oil is down about 8%, we expect very little returns. The superior returns, and this is actually quite interesting, the superior returns in the stock market coincide with periods of time that oil has been up a lot or down a lot. Obviously, for very different reasons, crude oil moves under the demand, the consumption of crude oil. Also, geopolitical factors certainly affect this commodity market as well. But the fact of the matter is, we don't really see great performance out of the stock market unless crude oil makes a big jump up over 35% at least over the past month, or has made a big move down about 30 or 40%. So make a mental note that if we see crude oil go up or down over 35, 40% in a month, well, that really does tell us something. That means that the market's due for something. When crude oil is very quiet, usually the stock market is very quiet, which is where we are right now. Down 8% on crude over the past month, historically has coincided with very quiet stock markets. Now we take a look at the federal funds rate, interest rates, which obviously over the past month has not changed at all. Well, as federal funds remain unchanged, we actually expect historically very little returns. Now, on a month over month basis, let's say this is 0.5% or 1%. If you annualize that, that could lead to a 12% return for the S&P 500, which is great. I mean, that's what we usually expect from the S&P 500. But we don't expect huge moves if the Federal Reserve hasn't made a move recently. But conversely, if the federal funds has increased by, let's say, 60%, so under those situations, under those circumstances, it means the Federal Reserve is raising rates because the economy is very hot. Lots of inflation. The stock market most likely has gone up a lot, and that coincides with stronger markets to follow. Now, if the Federal Reserve raises rates too quickly, that does lead to market sell-offs. And conversely, if the Federal Reserve is cutting rates by 60 or 80% in 1 month, well, that usually coincides with stock market sell-offs. Of course, history does show us if the Federal Reserve cuts interest rates by at least 100%, which is very rare in 1 month, that usually leads to better returns moving forward because the Federal Reserve has cut rates so quickly. But as we stand right now at a 0%, that usually coincides with rather slow and steady stock markets. Now we take a look at the 10-1 Treasury spread. Now this is a difference in yield between the 10-year bond and the 1-year bond in terms of yield. The difference between those two securities has increased 48%. Now, 48%, it means that the 10-year bond has risen above the 1-year bond, or the one has fallen below or fallen, faster than the 10. The difference between those two securities has risen by 48%. Well, we see 48% would put us right in the middle, right around zero, just a little bit to the negative side. I'm sorry, to the positive side, which does not indicate very much. However, when we see the spread increase dramatically, that's when that typically coincides with future markets to move very quickly to the upside. When we see, let's say, an 80% or 100% increase on the spread, that would be coincident or not coincident. That would be indicative of stronger markets. Weaker markets usually coincide with a contraction in the Treasury spread. Lately, the Treasury spread's been growing. Certainly, that's good news, but it's growing by a very small degree, so that usually doesn't coincide with big market returns. And then finally, we can consider gold, which has been strong lately, although very, very moderately strong, up less than 1%, 0.9%. Now, gold is a different type of commodity. It usually moves against the dollar. When the dollar goes down, gold will go up. With gold flat, that usually coincides with moderately strong stock markets, maybe 1% to the upside on a monthly basis. And again, 1% up over the month on the S&P 500 is not bad at all, because if you annualize that, that gives us 10, 12% a year. However, the superior returns we see from the stock market usually coincide either when gold is down, such as down 8%, 6%, or 4%. And that usually, you would think about it, coincides with a stronger dollar. And that would coincide with stronger capital inflows. Money's coming into the US from overseas, maybe because our stocks are going up. Conversely, we see very weak stock market performance when gold is down a lot. So if gold is down moderately, that's one thing. That is indicative of probably stronger markets in the future. But if gold really goes down a lot, that much, much stronger dollar probably dissuades capital investment. Maybe the dollar gets too strong for our taste. Well, we take all this and we put it together, and we know that uh, the VIX has been down about 34%. Crude oil is moderate. The federal funds hasn't changed. The 10-1 Treasury spread is up, just a little bit. Gold is flat. We take all these together. What does that forecast for our markets on the 30, 60, and 90 days moving forward? And this is not a trade recommendation. It's very simply taking a look at over 20 years of data and historically when we've fallen under these situations, how can we expect the market to behave? Well, given the current situation, on a 30-day basis, we expect, based on the VIX, the stock market to be up 0.1%. The VIX, given the VIX dropping 34%, we'd expect on a 60-day basis to be up 0.4% for the S&P 500, and the S&P 500 for a 90-day basis, 1.1%. Crude oil suggests that the stock market over the next 90 days would be up 1.5%, negligible on the 30 and 60-day levels. Given federal funds rate has been flat and the 10-1 Treasury spread has been very quiet, no indication. Based on gold, the 60-day forecast is around 1.1% to the upside, 90-day about 1%. And then finally, you take all the averages together, and this is what these indices indicates. That on a 30-day basis, moving forward, 0.1% to the upside S&P 500, 60 days, 0.7%, and then 90 days, 1.2%. So the takeaway from this is given the current position of the VIX, crude oil, federal funds rate, the 10-1 Treasury spread, and gold, history indicates we're likely to see a moderate trend to the upside, which really kind of coincides with what we see here. You look at the stock market every day. Lately, this S&P 500 is up 10, maybe 15 points for the day, maybe less than 1% for the day, and it wavers in that area, which is very indicative of what we see here. However, if we start to see the VIX really go up a lot, then, or down moderately, more than we have right now, that would be indicative of stronger markets to come. If we see crude oil make a very big move, remember above or below 35, 40%, that would be indicative of a bigger, stronger move. If we start to see gold, now not go down a lot, but go down moderately, maybe 8, 10%, that would be indicative of a stronger move as well. So that's where we stand right now. And I think it'll be helpful to take a look at these numbers moving forward, especially if we see a big move in the VIX or perhaps crude oil. Gold looked strong lately. We'll revisit these numbers on a regular basis, to hopefully we can forecast what's to come in the future. We hope this has been helpful. We look forward to seeing you back soon.